banking. You think when you put money into the bank that that money belongs to you, but the truth is that when you give the bank your money, you're actually giving the bank your money. The bank owes you that money, but you're a creditor, just like you had sold them paper clips. So the money that goes into the bank belongs to the bank, not to you. Now, banks keep money in the bank so that when depositors come in, depositors can get the money out. The money that we keep in the bank is called a reserve. In the modern world, we can also keep our reserves at the Federal Reserve Bank. If you go to your bank and you say, hey, I want to take $10,000 in cash out, they probably don't have it. They don't keep much money in the bank, just enough to cover what they think people are going to come in and ask for. Before the last 10 years, pretty much every country in the world used something called a fractional reserve banking system. And it was a very simple banking system. What it said was, someone comes along and they put a deposit in the bank. So you put $1,000 in the bank. The government would simply have a rule that says, for every dollar that goes in the bank has to keep 5%, 10%, 20%, some percentage like 12%. The Federal Reserve used to use 12%. So you have to keep this percentage in the bank of your deposits. And every bank that has the same deposits gets treated the same. It's a really simple system. You put in $1,000, the bank keeps $120, and they have $880 that they can go do stuff with to try to make money. 10 years ago, 2009, we had this huge financial crashy thing, more than 10 years ago actually now, but we had this huge financial crashy thing, and the Federal Reserve slowly over a 10-year period got rid of traditional fractional reserve banking and changed the way we work. And they did two things. One is they started paying banks interest on the reserves. So if I'm a bank and I put $1 million at the Federal Reserve to hold on for me, now I get interest from it. What does that mean? That means if the Federal Reserve is paying 5% and home mortgages are 4%, I'm not going to make a loan. I'm not going to make a home mortgage. I'm going to put my money in the Federal Reserve at 5 instead of making a home loan at 4. So the Federal Reserve can encourage or discourage banks from making loans by raising or lowering what it pays the banks. Okay? So that's called the interest on reserves system. But it's all part of something now called an ample reserve regime. And what this says is we don't have the same rules for every bank. There's no more 12% requirement, you got to keep this money. Each bank is going to have individual requirements based on that bank. So if you have a bank in Las Vegas and a bank in Manhattan and a bank in Iowa, and they all have the same amount of deposits, how they operate may be completely different because New York is different than Vegas, which is different than Iowa. So this ample reserve regime just says we need to make sure that banks have ample reserves, and each bank is going to have a tailored set of rules that apply to it. It should keep the financial system more sound and more stable, right? Yeah? Well, I think so. Somebody walks in the bank, they put $1,000 into their account in the bank. Really, you're just giving that bank $1,000 and they're marking you down in their books. Now, the bank can turn around and make somebody else a loan of your money. Now, how much money is there? Wait. The bank made a loan. You had $1,000. They loaned out $500. There's $1,500. The bank just created money. So this is where the ample thing comes in. The bank has $1,500 in deposits. It owes people $1,500, but it only has $1,000 in cash, the $1,000 that it put in. Now, most of the time, people don't ask for their money. So the bank doesn't even really need to keep $1,000. It can probably keep a whole lot less than that in the bank and get away with it and never have a problem. So the Fed is going to look at that individual bank and its operations and decide how much it needs to keep, and maybe the Fed will let them keep bonds instead of cash. They can do other things. It's this whole regime, ample reserve regime. Bank has $1,000 in reserve.
Tries to take their money
to
out.
keep $120 in trouble, but it has
$1,000
in the world.
That means
it has
$1,000
in cash
excess
sitting there in its vault. But every time they make a loan, that means somebody put money in, and not only does that person think they have their money, but now I loan that money to somebody else, and they think it's their money. A whole bunch of people end up owning, in their minds at least, the same money. And if everybody comes to the bank and tries to take their bank money out, we in big trouble. So again, when a bank is making a loan, that bank creates money. When a bank makes a loan, it creates money. Most of the money in our world is created through this process of banks making loans. And again, money is just sitting there in a computer. Money, for the most part, is just bits and bytes in somebody's machine. And again, what matters is our faith. We believe that if we go to the bank, we can get our money out. We believe that we can use that little plastic card in our pocket called debit and get our money out. And as long as we have faith, everything is going to be all right. What happens if we don't have faith? It's literally called a bank run when everyone runs to the bank to take their money out. If the bank has 12%, that means that most people, when they go to the bank, are going to get zero. The first people there will get their money. The later people won't. Okay, we have deposit insurance. Your money in your bank account is insured by the federal government if you have it in a good bank. And so you can get that money back, but really the bank doesn't have your money. And you might see a whole bunch of people running to the bank trying to get their money out. How are we going to save Gotham City? I just gave you a hint, and we'll move on and see.